As of today, Sunday, December 21st, 2025, the stock market is closed for the weekend, but we are looking at the final closing figures for C.H. Robinson Worldwide, Inc., trading under the NASDAQ ticker CHRW. The stock finished the most recent trading session on Friday, December 19th, at exactly $166.46 per share. This represented a solid intraday gain of $1.43, or about 0.87% on the day. While a move under 1% might look like a standard quiet Friday for a legacy logistics firm, the context here is actually quite startling. We are currently sitting near all-time highs for this company, a reality that completely contradicts the broader narrative surrounding the global shipping and freight industry right now. If you look at the general market sentiment, people expect the logistics sector to be struggling under the weight of a prolonged freight recession. The expectation is that with shipping rates normalizing and the Cass Freight Shipment Index hitting its lowest third-quarter levels since the 2009 financial crisis, a middleman like C.H. Robinson should be seeing its margins squeezed into oblivion. However, the reality we are seeing on the tape tells a much more aggressive growth story. While most investors were looking for a slow recovery, C.H. Robinson has managed to decouple its earnings power from the actual volume of freight moving through the economy. This is the curiosity loop that is keeping institutional desks awake at night. How does a non-asset-based brokerage expand its adjusted operating margins by 680 basis points to over 31% while the actual industry it serves is in a documented slump? The answer lies in a massive internal shift toward what they call the agentic supply chain. Instead of just being a company that connects a truck with a load, they have turned into a data-driven machine that uses proprietary AI agents to handle the micro-tasks that used to require thousands of man-hours. This has allowed them to grow their market share in the North American surface transportation segment, even as the total pie for freight continues to shrink. It is a classic case of a company using a downturn to sharpen its blade, and the market is finally starting to reward that efficiency with a valuation multiple that looks more like a high-end tech firm than a trucking broker. If you are tracking this move on your Fidelity trading platform or checking the charts on the Robinhood app, you've likely noticed that the volume has been remarkably consistent during this climb. We aren't seeing the erratic, speculative spikes typical of a meme stock. This is a disciplined, step-by-step accumulation. In fact, institutional activity has been the primary driver here, with major players like Barclays recently upgrading the stock to an overweight rating and pushing their price targets as high as $200. This kind of professional backing suggests that the smart money believes the current all-time highs aren't a peak, but rather a new floor. When you look at the Schwab Intelligent Portfolios or similar automated strategies, you're seeing C.H. Robinson show up more frequently because its beta remains relatively low at 0.90, yet its year-to-date return has outperformed the S&P 500 by nearly 40%. It has become a rare defensive play that is somehow capturing offensive-style growth. For those of you managing an individual brokerage account or perhaps using SoFi Active Investing to pick your spots, it's important to understand the tension between what analysts say and what the business is actually doing. Many of the older models used by traditional analysts still value C.H. Robinson based on cyclical freight cycles. They look at the low ocean rates and the soft truckload pricing and assume the stock is overvalued. But the reality is that CEO Dave Bozeman has completely changed the playbook since taking over. He brought in lean management principles from his time at Amazon and UPS, focusing on shippers' per-person, per-day metrics that have surged by double digits. They aren't just waiting for the market to get better, they are making the company so efficient that they can generate record profits even if the market stays flat for another 2 years. This is the kind of insight that separates someone just looking at a ticker on a screen from someone who understands the actual mechanics of the business. Before we get further into the technical setups and the 2026 outlook, I want to hear from you. Comment below how many shares of CHRW you currently hold, or if you're looking at other logistics players like Expeditors or Landstar instead. Does the current valuation feel too rich for a trucking broker, or do you buy into this AI-driven efficiency narrative? To really understand why C.H. Robinson stock is moving this way, we have to look at what they actually do. They are one of the world's largest third-party logistics providers. They don't own the trucks, the planes, or the ships. Instead, they own the information and the relationships. About 60% of their net revenue comes from North American truck brokerage. When a company like a major retailer needs to move 500 pallets from Chicago to Phoenix, they call C.H. Robinson. Robinson then finds a small trucking company with an empty backhaul and matches them up. They take a slice of the spread. In the past, this was a very manual, human-intensive process. Today, it's increasingly handled by their Agentech platform. This shift is why their personnel expenses fell by over 3% last quarter, despite moving more volume. They are doing more with fewer people, which is the ultimate goal of any scalable business. The company also has a global forwarding division that handles air and ocean freight, which makes up about 30% of their business. This area has been a bit more volatile lately. We saw ocean rates normalize significantly throughout 2025, which actually caused a drag on their gross profits in that specific segment. But again, the reality exceeded the expectation because they managed to offset those global headwinds with a massive win in the domestic LTL, less than truckload market. They have become extremely disciplined about which contracts they take, walking away from low-margin business that they would have chased in years past. This value over volume strategy is a hallmark of a mature, well-managed firm that is no longer interested in just being the biggest, but instead wants to be the most profitable. Looking back at their recent Q3 2025 earnings report, the numbers were a clear signal of this shift. They reported an adjusted earnings per share of $1.40, which beat the consensus by 11 cents. While total revenue actually fell by about 10% to $4.1 billion, their net income jumped by over 67% compared to the previous year. That is a staggering divergence. Usually when revenue drops 10%, you expect profit to drop at least that much, if not more, due to fixed costs. For profit to move in the opposite direction so violently proves that the cost-cutting and automation efforts are hitting the bottom line with massive force. They also divested their European surface transportation business recently, which further cleaned up the balance sheet and allowed them to focus on the higher-margin North American and global forwarding lanes. This kind of strategic focus is exactly what attracts long-term investors who use platforms like Fidelity Wealth Management or Interactive Brokers Trading for their core holdings. When you're doing your own online investing or looking for investment help through various investing sites, you'll see a lot of talk about the freight bottom. The idea is that we are at the end of a very long, painful cycle for transportation companies. If that's true, and we start to see even a modest 2 or 3% growth in total freight volumes in 2026, C.H. Robinson is positioned to explode. They have already proven they can grow margins in a shrinking market. Imagine what happens to their operating leverage when the market actually starts to grow again. This is why management felt confident enough to raise their 2026 operating income target by another $50 million, now aiming for a range of about $1 billion at the top end. At that level, we are looking at earnings per share potentially north of $6. For a stock currently at $166, a $6 EPS would represent a very reasonable forward PE ratio, especially for a company with such a dominant market position. Of course, there are risks that every self-investing individual needs to weigh. The biggest one is the macro environment. If the global economy takes a sharper downturn, or if consumer spending on physical goods shifts even more towards services, the volume of freight might just not stay flat. It could drop further. There is also the threat of competition from digital native brokers who are also trying to use AI to undercut the incumbents. However, C.H. Robinson has a massive advantage in its scale and its data set. They have over 100 years of shipping data to train their models on, something a startup simply cannot replicate overnight. This depth of data is what makes their agentic supply chain more effective than a generic AI solution. They know the lanes, they know the carriers, and they know the seasonal patterns better than almost anyone in the world. If you're using the Robinhood mobile app or the Fidelity mobile app to track your daily swings, keep an eye on the $167.10 level. That was the intraday high on Friday, and breaking above that with volume would likely signal the next leg up toward that $184 to $200 analyst range. On the downside, there is strong support near the 50-day moving average, which is currently sitting around $148. Any pullback to that level would likely be seen as a massive buying opportunity for institutional investors who missed the initial run-up.